Welcome to the Real Vision Daily Briefing. It's Tuesday, August 3rd, 2021. I'm Ash Bennington. Once again, it's TG Tuesday. I'm joined today by Tony Greer, editor of the Morning Navigator. Here's what we're looking at right now. U.S. equity markets, for the most part, higher today. Looks like all the major indices are in the green. S&P 500, the largest winner on the day, up 0.82% to close at 4,423. Big winning sectors on the day are healthcare, energy, and financials. Also out today, a report from the Federal Reserve. Household debt in the U.S. rose $313 billion. That's the fastest level of rise since 2007. It's nearly $15 trillion, according to the data out today from the Fed. To put that into perspective, that's nearly 3/4 of U.S. GDP, which weighs in around 21 trillion in household debt alone. This number really knocked my socks off today. The majority of that new debt is from mortgage origination. Over the last 4 quarters, mortgage origination totaled $4.6 trillion, which is 44% of all outstanding loan balances, according to reporting out today by CNBC's Jeff Cox. That is quite a statistic. Finally, on the day, a major speech from SEC Chairman, Gary Gensler, at the Aspen Security Forum today, talking about the role of regulation in the digital asset, Bitcoin, cryptocurrency space. We'll have more to say on that later. But first, Tony Greer, welcome back to the show.
Ash, great to be back, my man. How you doing?
Good, man. We missed you.
Oh, it's nice to be missed. It really is nice to come back from a little trip and have people say that we're looking forward to hearing your comments on the markets, and it's great to be able to provide that, right?
Yeah, so let's jump right in. What are your thoughts? What are you looking at right now? What did we miss? Bring us up to date.
Yeah, as a performance hawker, Ash, on August 3rd, I'm still sort of resonating on the July market performance. Right, that's actually following through on our screens now as the S&P climbs to essentially what looks like could be a new all-time high close today, if not, within a couple of days. But I think the important thing to note is that in July, the S&P extended obviously to a new all-time high. It made 8 out of 9 of the last months of rallying in the S&P. We've got a tremendous streak building up here. When the market has been this strong in the first half of the year, you'll have those stock market almanac people reminding you that the performance is usually really good into the end of the year. So I feel like we're right in the power curve of that trade where we can kind of ride this carefully and perhaps non-linearly, but into the end of the year. And I love that you opened up with the household debt data, because I do think that that's important. And I think it's also a very close offshoot to why the dollar backed off in July. And I think that this is relevant for a couple of reasons. The Federal Reserve concocted this dollar short covering rally to really put some heat on the commodity complex in order to make their transitory comment seem like it was really pertinent. And then we had Jerome Powell come out last week when I was away, and this was a clip that you couldn't miss from Europe about his literally verbal diarrhea trying to discuss what type of inflation we were having and how some prices were going to be persistently high and other prices might be transitorily high. But what it sounded like to me was that we've got a Fed chairman that is actually way more concerned about the inflation picture than he had led on to being in the past. So when I look at the debt number that you brought in this morning and I compare it to the fact that, right now the dollar is just not going to be able to rally when we've got a $21 trillion economy with 30 trillion in debt and a balance sheet that's expanding through 7 trillion with no signs of stopping right now. And as you know, that no sign of stopping by the Federal Reserve or the global central banks has been a pretty strong tenet of our assets are being inflated trade. So I think that that's kind of relevant. These debt numbers do come back. They do weigh on the dollar. And what's interesting to me is that, bonds are bid over right now. So that for me is something that's really, really hard to tend to contend with when we're trading into this inflationary scenario. we've got 10-year yields now backing off towards 1.2% and lower. We've got all of the curves essentially tightening up from the highs. And we've got 5-year break-evens that have remained fairly bid, showing that we do have inflationary stirs around the market. So this has been very difficult to unpack, Ash, where bonds continue rallying, stocks continue rallying, commodities continue rallying, and here's the Federal Reserve over on the side saying, this inflation is going to be transitory. So the picture has gotten a little bit difficult to discern, and that has, to me, shown through in the July performance of the stock market, right? We saw the S&P rally to a new high, but the rotation was barely recognizable for me. We had healthcare, utilities, cybersecurity, and software leading the market. We had, in the negative side, we had energy getting trounced for 8%, transports losing ground, social media and cannabis getting lambasted, and the S&P is still able to make a new high. So when that rotation changes to something I don't recognize, we have to sort of wait and see how things pan out. And that's really the stage that I'm in right now. I know there's a lot to unpack there, but that's my story, and I'm sticking to it.
Tony, you just set us up for a 3-hour conversation.
That's what we're going to do today, the marathon daily briefing. Exactly.
Yeah, indeed. Caputo and Nick will kill us if we do that, but it's good to know we do have enough material to do it. Look, some really important points. I don't think we quite got to an all-time closing high today on the S&P, but it looks like we're really close. We're in flirting distance there, right? Really close. I'm looking at bond yields. You were talking about the U.S. 10-year. Look, we've dropped, it looks like, from a high of around 1.74 in April on yield down to 1.17 right now. I mean, that is striking, man.
An incredibly fast rate of change, which needs to be respected. It kind of describes to me, it's another case in point why I don't stick my hand into the bond market buzzsaw and let it get chopped off, because it would have gotten chopped off with yields as low as they are, right? There's a few things that have resonated with me, Ash, and, you'll appreciate, you like listening as much as I do to guys like Grant Williams interview Kyle Bass. And that recent interview was just launched yesterday. And I love that Kyle was all over. Two things to me were important. Number one, he was all over the fact that he thinks the Fed is not going to end this posture of constantly accommodating markets, which is a theme that we've discussed here. Remember when we talked about Felix Zulauf and $40 or $50 trillion Fed balance sheet? Okay, Kyle Bass is of the same mindset. The other thing that I loved is that he's saying, I'm going out to dinner here in the States and I'm getting the dinner bill and it looks like I'm paying in pesos. The number has inflated so much for dinner for two in the U.S. And so here we have that dichotomy of the inflation signals hitting your wallet full force, hitting your grocery bill full force every month, a little bit higher, incrementally higher. And the Fed saying there's not much inflation and the bond market is agreeing with the Fed. So, we don't have a leg to stand on here as market participants looking for inflation. Meanwhile, we know it's happening, right? So the idea is, what do we trade, right? How do we get in the right lane? And I'm still sticking with the idea that the oil market is very much intact, right? We've had a little pullback from the highs, but structurally, the market is well intact there, as is the commodity rally. So we've got to really just sort out now, why bonds, stocks, and commodities won't stop making new highs every day and figure out which train to get on. It's really difficult, and it's a very transitionary portion of the trade to me. But I have to be honest with you, that's the conversation going on in my head.
Boy, that's a complex and nuanced picture that you paint. This divergence between the real world and financial markets. Listen, I'm a New York bachelor and the world's worst cook. I know how horrible the food prices are, especially with prepared foods. $22 for a grilled chicken sandwich. I mean, it's just crazy out there. And I think that it seems like maybe it's some labor shortage getting factored in, because prepared foods are a lot higher right now, or the rate of change in prepared foods is increasing at a faster rate than the rate of change in food in general. But this does speak to what you were suggesting, this disconnect between financial markets, understanding the different directions that bond markets are going in versus U.S. equity markets. By the way, we should probably say DXY U.S. dollar index 92.05 right now.
Yeah, like we said, the dollar index has backed off the highs, but yields have not recovered. So you're sort of seeing, the dollar index starting to show that inflationary trade coming back. If you remember, the yields were making their highs when the dollar was on its lows. Clearly, we're away from the lows now with the rally that the Federal Reserve manufactured, but commodities haven't backed off and 5-year break-evens haven't backed off. So you can make some cases in the market where, the trade is still intact, and there are other places that it's gotten blown apart and maybe overshot. And I think that probably speaks to positioning being offsides. It feels like the grain markets have run into at least a little bit of a technical quagmire where they're not making new highs every day. We saw lumber back all the way off. But it feels like the reality, Ash, I was able to basically unplug from the screens for a good 10 or 11 days, literally without looking at any prices or any price action, and just sort of picking up headlines here and there, but remaining totally confident that, the S&P rally was going to be intact, that the oil rally was going to be intact. And for me, it was really empowering to come back and flip the screens on and have them tell me, yeah, that's pretty much what's going on. There are a couple of challenges here and there, but right now we're at, at the juncture in the trade where we're getting a little bit of a change in the rotation, but it's still generating the same result, right? Incremental higher highs in the energy markets, incremental higher highs in the S&P, a few gut checks here and there, but the market is bouncing off of support levels and showing you that it is actually still in a destination to higher places. And so with that being the core tenet of what we're looking for, if we can have the rotation match up with what should be happening in our head, which would be, a continuation of the base metal rally, a continuation of the gold rally, a continuation of the energy rally, those things aren't happening right now. But at the same time, the S&P is holding it together and continuing to make new highs. So it's for now, for me in my head, it's just deciding whether I'm weighted properly in this sector rotation for the next phase of the rally. And so it's obviously, yeah, if that's fair.
Yeah, no, I was going to say, tell me about that. What do you think about your weighting right now? Obviously, one of the things that's been interesting to me, and I think to you, is just the whipsawing sector to sector that's been happening. Who leads, who follows, who declines, and yet at the same time, the aggregate indices marching higher. Tell me how you think about that sector rotation and how you position for it.
Yeah, Ash, we've been. I'm just looking at my view matrix here just to go over it, and we've been postured long the energy market. We've been postured long metals and mining, but we've been shaken out of that length right near the top as that metals and mining sector came off. But as we're still bullish that sector, it didn't really back off much, and it didn't give us a chance to get in very cheap either. So when you're looking for those things to keep going, and then you turn and you look at July's performance, and the market is led by healthcare and utilities, two sectors that I have precisely zero exposure to. I have to do a little bit of a gut check and say, am I chasing down these commodities, or are these commodity trades now getting a little bit later innings? And maybe I should posture into something like healthcare just for technical reasons. Maybe I should swing into something more like financials if those are going to pick up and run again. Should the yield curve hold in here, and should yields hold here? If yields hold in here, then financials are still dirt cheap at these prices. So there's a lot to consider. And, those are the conversations that are going on in my head right now as I sort of re-enter after taking a little break and coming back with a lot of dry powder that I'm looking to employ, but I want to employ it tactically. I've been looking to get into the grains trade, and I've been looking at some of the I've been looking at some of the chemical trades as they are offshoots of the oil rally, obviously with petroleum byproducts potentially rallying. So that's really what I'm doing right now as I get back in, is sifting through the sector performances. And I'm going to be really keyed in on this week's close to see if it's a continuation of that July rally, or if we start to see the manifestation of what I'm expecting, which is more rallying in inflation-based sectors, metals and mining, gold stocks, continuation in oil, a pickup in transports, and then following on with financials and technology.
Yeah. To hit on the inflation trade and also the point that you made about rate of change, I have to tell you that report that I was talking about out of the Fed on the levels of household debt, the one statistic in there that I literally needed to read 3 times to make sure that I got it right was over the last 4 quarters, mortgage origination totaling nearly $4.6 trillion. And this is the killer, which is 44% of all outstanding loan balances. So, in other words, 44 cents of every dollar for U.S. residential mortgages outstanding right now were originated in the last 12 months. 30-year mortgages, 20-year mortgages, 25-year mortgages, 44% originated in the last 12 months.
People are taking advantage of the cheap rates. It's part of that secular push, out of big cities and that secular push into home offices. And I think, that's really what fueled a lot of that borrowing.
Yeah.
It was sort of anecdotal, I think, this time around, Ash, where we can actually, look into the newspaper and get a little bit of an idea why that's happening. So at least it's not as alarming. It takes some of the sting out of it. But, I agree with you. You point out these numbers are getting historically stretched now, and so you have to wonder if there's going to be a pullback to the mean, right? And if that's a pullback to the mean, and then maybe there's a pullback in the housing trade, which we haven't really gotten at all yet, that I would welcome if there was a steep dip, because I still think that they're set up for success. I know that there are some really strong opponents to that trade, because I know that mortgage applications have backed off since the highs and since all of that debt was taken out. And so there's certainly the argument that the home builders could be in a position to back off sharply to match up with that back off in mortgage applications. I would relish that dip if it came. And I'm kind of respecting the view that guys like Julian Brigden have about builders backing off here. But I am very much postured the other way, as in I'm flat looking to buy them rather than short looking to ride the trade down.
Yeah, I think you made 2 important points there. First of all, some of that's refinancing action, obviously, with historically low rates. And second, those numbers have backed down in terms of the new application, new construction. Some of the indices of future construction have slowed. But man, that is just a striking number.
Yeah, it's interesting that you point out that I like that you say the pace has slowed in that housing sector. Similarly, Ash, we saw ISM data yesterday, right?
Yeah.
ISM manufacturing data comes out, and we've been watching the prices paid module. We saw the ISM prices paid, I think, in June tick up to 92. We came in yesterday looking for like an 89 and got something like an 85. So, prices paid while still trading at the high end of the range, therefore inflationary, has slowed the pace a little bit, right? And maybe that's the explanation for the bond yields backing off so much, even though we think they've gone farther than they should have. But it does make sense to me that, the reopening pace, the mortgage application pace, the home builder pace, the energy rebound pace, all of that was scorching for a little while. On the highs, when we're seeing, jet fuel consumption pick up, we're seeing refinery utilization pick up. So, the cyclical trade was literally burning for a while as we had that big reopening party for a couple of months. So it makes perfect sense for me for this trade to sort of back off in nonlinear fashion, trade it to support. And then I think it seems pretty telegraphed to me that a lot of this inflation trade is going to get back on its feet. And the reason that I can say that is because, a couple of weeks ago, we were talking about the Federal Reserve comments about, the inflation being transitory. And we got this huge dollar rally that, knocked crude oil back to 65. It knocked the S&P back to 100-day moving averages, thinking that back to its 50-day, thinking that the Federal Reserve was going to start a tightening cycle. And here we are, and the stock market keeps pressing on, making a new high. Bonds keep going. And so it looks to me like this is going to continue for a little while we sort out which market is right, the bond market or the stock market.
Boy, you're so right. Such a complicated picture out there. RIP historical correlations across the board in so many ways. And look, the ISM number from yesterday. So the rate at the price at which manufacturers were paying, manufacturing prices fell by the most in 16 months yesterday. This is on the factory ISM, the second month-over-month decline. So, you try and think about things at the margin. You try and think about things, the second derivative, the rate of change. We saw obviously this collapse, then this huge rebound, and now we're seeing a decline in the rate of expansion. It's a very complicated picture to sort of telegraph and figure out, but it does seem like the rate of growth has slowed, in some cases slowed dramatically in several key ways.
Yeah, and I wanted to ask you, how does it feel in there on Marcus Island, where everybody's going to need a vaccine passport to go to a restaurant, to a gym, or to see a play?
I don't know. I got vaccinated the minute I was able to, like in May. So I'm good. But that is the word coming out today. That's the speculation. We'll see if it actually gets passed. Has it been passed yet? I don't think it's been passed, right?
No, no. De Blasio's pushing it, Cuomo's pushing it. All the mad are pushing it. So it's it seems like something that we're definitely be having a conversation about, probably a lot faster than anybody, a couple months ago, that this was conspiracy theory that we were going to move to any kind of a vaccine passport. And now here we're talking about it right in New York City. And I think that the ramifications of that, will be kind of devastating, because I think that we'll get to the point where, I think a lot of people that have been living under the idea of my body, my choice, as was being pushed by, most parties. And all of a sudden, that seems to not be the case now that we're dealing with this pandemic with the 99.9 something survival rate. So I think we're coming to a head here on the tyranny versus freedom conversation. And it's interesting to see it happen right in my backyard. I'm very interested to see how that works out for the restaurants that are going to be checking papers, as it were, out the door, because I'm going to guess that a lot of people are going to get turned off by that.
Yeah, well, we're going to be following that through markets, certainly, to see what the impact is, which is our remit here, and to think about how that has an impact on markets. But right now, still in the very early phases of that conversation. Tony, to shift gears here a little bit, I'm curious if you happen to see any of the speech or read the text of the speech by Gary Gensler coming out of the Aspen Security Forum today.
I saw the headline, and I kind of watch it the way that I watch Bitcoin. Is I don't get too caught up in it. I see the headline, I look at price action. To me, price action is following the narrative to a T, right? We held down at 30K. For me, that was shocking. I thought it looked like Bitcoin was going to curl over down to 20K. The chart looked terrible. It was a classic case of the hodlers got together. Nobody's selling through that level. It dipped below 30K a couple times and came roaring back. That was a sign for the bulls to get involved. We tiptoed into Mike Novogratz's big party out in the Hamptons that I'm sure was centered around Bitcoiners and laser eyes, and Bitcoin rallied into the weekend. And then we got these headlines from Gensler that bring it back into reality lens, where, if we're going to start talking about know your client rules for cryptocurrency trading, that means that there's a lot more regulation that's going to come down the pike. So it does make sense for me to see Bitcoin fail 40 something K and back off into the 30s again. I still think it's destined for another test of 30K and a fall through there, but it may take some time. It's just turning out to not be the best inflation trade, but that probably has a lot of other good use cases in its wheelhouse, that's attracting plenty of bulls that I completely understand.
Tony, let me read you and our viewers a quote. You tell me if you think there's any ambiguity here. This is coming from Gary Gensler. Quote, "We need additional congressional authorities to prevent transactions, products, and platforms from falling between regulatory cracks. We also need more resources to protect investors in this growing and volatile sector. We stand ready to work closely with Congress, the administration, our fellow regulators, and our partners around the world to close some of these gaps." Does that sound like a man who's serious about regulation or not?
Man, sounds like he means what he says and probably says what he means. And I tell you, these are the things that is going to be a great battle to watch for me, right? Because we're definitely going to have to see, Gensler obviously has one eye on the Bitfinex story, which is finally coming out, Tether collapsing, and I'm not following it closely. I'm following it with one eye. But, it looks like this is not going to be an extinction event for Bitcoin, rather a sort of come to reality event for Bitcoin where, maybe if Bitcoin lives through Gary Gensler's regulatory plan for it, that will be another great sign of success for it. If it knocks a couple of percent off the price, I wouldn't be shocked. But these are the battles that have to get fought right before our eyes, so that as traders we can see what the market is actually calling for, right?
Yeah. Let me just say, as somebody who watches crypto Twitter pretty closely, today has been an absolutely fascinating day in that space. There are a lot of hot takes out on Gensler's speech. Very few of them, interestingly enough, in agreement. The Bitcoin maximalists, the people who consider themselves Bitcoiners first and foremost, seem to see this as something that's relatively positive for Bitcoin. They believe that Gensler is focusing more on securities, more on DeFi, more on things effectively that are not Bitcoin. He actually signaled in the beginning of the speech some very positive and very supportive things for Bitcoin itself. He talked about the Satoshi white paper, its impact on him personally. So there's some speculation out there about whether or not this is going to hit Bitcoin. Price off a little bit today. It looks like off about 2.7%, which in Bitcoin, trailing 24 hours, which in Bitcoin land is not a huge amount of volatility. It's down, trading around, well, it just broke 38,000 literally as I'm watching it right now. But there's still not a huge amount of volatility in Bitcoin land. So there is this speculation about, is this something that is going to hit maybe more of the things that look, taste, and feel more like securities than Bitcoin? And we should probably also point out that Tether still has not broken its peg. It's still trading flat at $1 or thereabouts. So a lot of uncertainty, a lot of questions. I've got a poll out on Twitter right now that I just released a couple of hours ago about what we're going to call, how will future generations refer to SEC Chair Gary Gensler's speech. He says he calls it the Wild West. That's option one, will be the Wild West speech. And option two, this is my favorite. I'm not allowed to vote because I created the Twitter poll, but the make no mistake speech. He says the phrase make no mistake 3 times in the speech, and he's saying it in reference to folks who don't think U.S. securities laws apply to what are effectively, in Gensler's views, U.S. securities. So a lot of interesting stuff happening in that space right now.
Totally is, man. There's a lot to follow and a lot to unpack, but this seems like a pretty main event for the crypto people, right?
Yeah, absolutely. It seems like the first inning or the first pitch maybe of the main event.
Yeah.
It's still very early, but it's also interesting in the space. There's kind of this split between the folks who have more of a sort of cypherpunk libertarian bent, who are very much against regulation, and there are a lot of people who have been in or close to the institutional space who are saying, in effect, hey, regulate us. We want to be regulated. We want to be able to grow this so that institutional players can come into the space, can feel some comfort in the space. So that in itself is almost maybe a burgeoning civil war or a Cold War being fought within the space itself. It's just an incredibly interesting time. And again, I say this all the time, but I think it's still so early in this space, right? I think it's just so early.
Yeah. I mean, financial deregulation is, still excuse me, I shouldn't say that. Yeah, financial, I guess, deregulation or decoupling from legacy financial structure seems to be what the market is pining for. And, that's a trade that you definitely don't want to miss. I haven't figured out the capacity that I'm going to be able to capture it, but it definitely feels, you can see the companies, the Squares, the eBays, and that companies are getting more relevant than big banks in a lot of ways in terms of how much consumer capital they're holding on to. And, there's a tremendous amount of change happening before our eyes. It's literally next to impossible for me to keep up.
Yeah.
But, we've got last sale to Tether 2. And, Bitcoin to me, for if you would have asked me what price Bitcoin would be trading while Gary Gensler is coming out with a pretty clear, plan to at least begin the conversation about regulating it, I would have said that we would be trading down through 32K rather than up here at 38K. So, Bitcoin is still showing that there's plenty of institutional investment around, and it's holding a pretty decent price for the headlines that it's taking on, if you ask me right now. So that's a pretty good feather in its cap. We'll see how it pans out.
So many great points there, and I think that maybe some of the coins that look a little bit more like securities are getting hit a little bit harder. Just sort of anecdotally flipping through that data, but so many good points. We're right at the very beginning of this almost Googleification of financial services and financial markets. To harken back to something that you mentioned earlier, something from more of the legacy world that we watch very closely, which is oil. We have a clip that I wanted to show here. This is a conversation today, an expert view that we did available to Real Vision subscribers from Samir Madani. Let's take a look at the clip. This is about tracking illegal oil tankers.
In my line of work, I do a lot of imagery analysis of the vessels that move around the world in a very stealthy manner. And in order to avoid detection, they do some pretty funny things. In some cases, they show up with a completely fresh coat of paint, and it's a different color, obviously. It might go from green to red. And so you're sitting there, stroking your chin, wondering what you're looking at. But in our case, we also have folks taking ground imagery. So they have lengthy lenses, and they're taking photos of these vessels from great distances at different angles. And we're catching the names of the vessels, or just maybe they paint off the sides of the first and last couple of letters, so you only get the middle portion, which is pretty funny. I have a case right now in Venezuela I'm looking at. And in some cases, they are short on time. They can't come up with enough paint for the work, so they invest in nylon tarp. And the kind of nylon tarp that you use to cover an entire facade of a building when you're, during winter, while working on the facade to trap the heat. Now they covered the deck and posted on Twitter the other day. There was a vessel that pulled up at Jose Terminal, and we saw these 4 strips of nylon on the different sides of the deck. And so it looks like a red vessel, but it's got these blue stripes along the length of the deck. So every week we're discovering new tactics, and most of they went from just manipulating the AIS beacon data to now also going that extra mile or putting in that extra effort to change the physical appearance of the vessel.
So there you have it, a really interesting sort of view of this really strange world that I didn't know much about illegal oil tankers and the extent to which folks will go to camouflage those tankers. That's the kind of depth and analysis you're probably not going to see anywhere else but Real Vision. Tony, we were talking a little bit off camera about some of the things that you're watching in the oil market. Give us a bit of a sense of where you are.
Yeah. I tell you, I like that clip, and I want to rewatch that because it reminds me of the Mark Rich side of oil trading, right? There's the sort of, the transparent side that you see on the screen, and then there's this renegade side to oil that actually takes place. That's almost like a black market for oil, but is actually pretty significant, as we just saw. But what was really cool to me while we're on the topic, and I just want to kind of tie one more point into this great interview with Kyle Bass while we're talking about oil, since he's very much an expert in the space. As soon as they got on the topic, Grant and Kyle comes out and says, I think we're going to see $100. And for somebody that's positioned long, has the same idea, I basically jump out of my seat and say, why? And he is very clear on it. And I want to read this one quote that I thought was really great, and along the lines, Ash, of things that we've discussed here. Okay, let me quote Kyle Bass. We're in July of 2021, after 7 years of malinvestment, and the crowd that is virtue signaling that we can just flip a switch and go electric. I think they haven't done the math, and I don't think they realize that hydrocarbon demand is inelastic, right? And that covers a lot of the ground that we've spoken about with this green movement, saying, okay, we're going to go to wind and solar, and not having calculated how much fossil fuel and actually how much metal it's going to take to get us there, right? So it was exciting to hear that, another fellow oil bull is looking at this market, which is very much skimming the highs, and nothing is changing about his bullish posture. Right? That reminded me of how we've been looking at it. And we're saying, yeah, I know oil's gone from $10 to $75, but it might be a better buy here than it was down there, because really there's very few things standing in the way of the oil market right now, other than getting blindsided by strict and harsh lockdowns. So I just thought that was really cool that he was kind of looking at it and very suspect of the green movement, very calm and collected about how the market is very much taking all the news in stride, staying on the highs, and he remains as bullish as we do. So that's just another view to share while we're coming off of that cool story. You know what I mean?
Yeah, it's really interesting. You and I have been having that same conversation right here on the Real Vision Daily Briefing for a long time. Listen, solar and wind and tidal energy, green energy, wonderful. I love it all. But the reality is, in terms of where we're going to be fueling up in a week, a month, a day, a year, it's going to be hydrocarbons. And that's not a statement of something that I want to be true. It's just the reality of the physical mechanics of the demand right now and for the foreseeable future in hydrocarbon. Again, not a position against the green movement, just a statement of fact about how long it's going to take to complete this transition. This is going to be something that your kids are going to be figuring out.
Yeah, totally. It was funny that how you put that, and I thought of the fact that we just saw refinery utilization come out of the tank from the time that all the airlines were shut down and grind higher all the way back to pre-pandemic levels of refinery utilization. Meanwhile, the cost of gas has doubled along the way. And I think that that's what Kyle is talking about when he's saying that the green movement hasn't figured out that hydrocarbon demand is inelastic, right? Meaning gasoline buyers don't really care incrementally at the margin, the extra nickel that they're paying. They're going to fill up their tank, right? They're going to fill up the jet fuel tank so the plane can get across the Atlantic. It's just what's going to happen. And so I just think it builds a further case for us to be confident about the fossil fuel trade coming back to life. That's all.
Right. Exactly. Not a moral judgment, not a political judgment. It's an economic judgment of fact and the way that these markets trade. Tony, in honor of your return to the Real Vision Daily Briefing, what do you say? Can we do a quick speed round, get some questions in?
Yeah, let's do it, man. I'd love to hear some. Love to hear what's on people's minds.
Here's one from Hef. Tony, what are your thoughts on the marijuana sector in the short to medium term?
Bad, right? We just had a month of July where cannabis was the worst performing sector on my radar screen. I think the US MSOs were down 10 or 11%. I think the Canadians were down something like that, something in the ballpark. I've been cautious mainly since for technical reasons, quite honestly, because as we were legalizing state by state through the election and things like that, we got on the path. Chuck Schumer put us very clearly on the path toward federal legalization. And while all that happened, the cannabis charts all put in these big head and shoulder tops, right? What was interesting to me was that as they broke down through the neckline, we didn't see a lot of buying, even though we're talking about federal legalization on the tape now. So it's scaring me that we haven't reached a bottom in the sell the fact trade. And I'm very nervous about the cannabis stocks in the short term. In the long term, I mean, give me another 20% discount and you're going to force me to put some money to work in this space, as in a first dollar I'll be putting back in after taking profits and riding that trade on the upside for a little while. So I'm letting the chart speak to me. And the fact that it's got a scary toppy formation now has sort of got me saying, I'll wait before I can buy some cannabis stocks. And I think that I can get them cheaper. That's how I'm looking at it.
Yeah, such a great tactical analysis and a tactical breakdown of the way you think about a sector that you're structurally, secularly long on, but bearish on in the short term for price reasons and some of the news cycle stories not moving the tape. Right. Another one comes to us. This is a question from Lena. I'm going to update this with what we already know. Lena's curious about what your time frame is on oil. You're bullish there. How do you think about your time horizons?
I think I look at the oil time horizon really, as a price action junkie, just kind of decide if it can maintain the trajectory that it's on. And when I look at when oil steps into the ring, I'll call it, right? When the oil rally and the bulls and bears get in a big fight. Like, for example, in the middle of July, when OPEC came out and said they were going to allow the UAE to increase production by 400,000 barrels a day starting in a couple of months, right? That seemed like the perfect sell the fact event for the oil markets. We had been leading up to that. We had Jerome Powell construct that dollar rally out of the FOMC minutes and really put this bond market rally in motion that took some heat off the inflation trade. Following that, we got that decision out of OPEC that knocked crude oil down from 72 to 65 and back in all of 5 sessions. So when I see dips in crude oil that steep in price and short in duration, it gives me confidence that this market can take a licking and keep on ticking. So as long as we remain above the 100-day moving average here, I look for crude oil to trade, $75 in a couple of short weeks, and then progress to 85 in a couple of months. And then I think by the end of the year, we'd be in the high 80s, low 90s, looking for 100. And so that's kind of how I'm pacing it out right now. If the chart can maintain this trajectory, get the ruler out and see how long it's going to take us to get to your price target.
Yeah. Final question for you, Tony, if we can keep this one short, because I'm mindful of the time. It looks like we've run a little bit long. But Ralph Humphrey wants to know, what commodities is Tony most bullish on and why? I think it's a great question.
It is a good question because the deck keeps shuffling quite a bit. I don't want to beat a dead horse because he's obviously listened to us speak about oil now, and I don't want to go, reiterate that diatribe on the short term. But what's interesting to me right now, aluminum making new highs for the move very quietly, right? China tried to take the heat off of the metals market. What they wound up doing was backing iron ore off the highs. All of the other base metals just consolidated in a range. Next thing you know, as soon as China stopped making comments about trying to bottle up the commodity rally, aluminum breaks off to a new high. So to me, that's symptomatic of what we've been seeing over the last year, where every time you turn around, it's a new commodity taking the lead. So I'm going to be focusing on oil in the short term. I'm really bullish, but I've got to keep my eye on this copper and aluminum complex here that looks like it's about to pop again.
Yeah. By the way, I should say, it looks like this mandate in New York for proof of vaccination is going to be going into effect. I guess it can come directly out of the mayor's office. Looks like August 16, enforcement beginning September 13. We should point out there's some pushback happening right now by places like the New York City Hospitality Alliance, which is a restaurant organization. I suspect we will be hearing more about that story, especially in New York.
Yeah, they're all going to push back from the idea of pushing customers out of the door of their restaurants after they were shut down for, half a year or a year. So, it seems to me like we were just getting some momentum to get back into, full economic reality again. They made up another variant, or maybe the COVID made up another variant that's going around. They're trying to sell the narrative that every time the markets go down, it's because of the variant. I think it's a really interesting conversation, and this is going to be where the rubber hits the road with the tyrannical overtake in New York City, and I don't think the people are going to go for it. Some will, some might, and in the end, I think that the stores and the theaters that try to implement this will be the ones that are suffering dearly.
Yeah. Tony, final thoughts on markets. To summarize, you've been away for a while. What are your final thoughts, big picture, where we are right now?
From 30,000 feet up, man, you've got central bankers, you've got the Chinese Communist Party, all trying to take shots at the commodity rally and cooling it off. And when I come back from not looking at prices and flipping my screens on, and I see stocks, commodities, and bonds bid only, it looks still like a pretty healthy, liquidity-driven rally to me, with the Fed making no comments about reversing course and the balance sheet ticking higher. So if we're sticking with this idea that the Fed is inflating assets, and if you have assets, you're going to be okay. The screens now corroborate with that, where the S&P keeps making a new high. We've got the bond market rally to sort of sort out mentally and see what that means with our inflation. But when I look at the BCOM still scraping the highs with grains coming off, I can't help but be a secular commodity bull still coming out of that March lockdown low. Nothing's changed about this picture. We've got supply constraints, tight inventories, and it just looks like the commodity trade is a one-way train right now.
Tony Greer, very well said. Welcome back. It's great to have you back on the Real Vision Daily Briefing.
Great to be back, my man. Hopefully we'll see more of you in the near future, Ash.
Indeed. Thanks for joining us, everybody.
Thank you.